It's June 2021 here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, fiscal policy. Since the U.S. economy entered a recession in February of 2020, the U.S. government has taken unprecedented action to reduce the economic shock created by the COVID-19 virus. This action included historic fiscal spending and, as a result, surging debt levels. As we seem to be on the other side of the pandemic, the question now becomes what fiscal policy will look like going forward. President Biden has proposed a $6 trillion budget that would take federal spending to its highest sustained level since World War II. The plan calls for total spending to rise to $8.2 trillion by 2031, with annual deficits running near $1.3 trillion over the next 10 years to fund both a massive infrastructure plan and added social benefits. Democrats and Republicans still appear far apart on an agreement on the size and details of such a package, or even how it will be funded. One such funding source could be tax increases, as the Biden administration proposed to increase individual income tax rates, expand application of the employment tax, and raise the capital gains tax, much of which is a non-starter for Republicans. Whatever the final package looks like, it will certainly have implications for financial markets. Number 2, monetary policy. Despite some areas of the economy still lagging their pre-pandemic levels, the U.S. economy continues to recover at a rapid pace. Economic data suggests that the economy is firing on most cylinders, absent a strong labor picture which continues to recover slowly, but there's yet to be any action to reduce the easy money policies enacted to help jumpstart the economy. While recent Fed minutes reported that some FOMC officials want to begin discussing a plan for reducing the Fed's massive bond buying program in a future meeting, we market participants still have little indication as to when that might be. A Fed funds rate near zero and the Fed's commitment to at least $120 billion in monthly asset purchases have helped to propel equity markets to fresh all-time highs. But now the focus is shifting to the future and what a change in policy might mean for financial markets. Any reduction in the pace of Fed asset purchases or talks of an increase to the Fed funds rate will certainly have market implications, and we continue to evaluate the potential effects of such actions. Number 3, inflation. You can't talk fiscal and monetary policy without mentioning inflation, a topic that just so happens to be, well, hot, just like the recent inflation readings. Like most investors, we remain steadfast in trying to determine if the current bout of inflation is transitory, as the Fed suggests, or if it's something bigger and longer lasting than that. With all the accommodative fiscal and monetary policy resulting in a strong economic recovery, we now face the task of trying to determine the longer-term outlook on inflation and rising rates across global economies. Prices are rising at a pace not seen since August of 2008. The fact that inflation is rising from year-ago periods isn't a surprise given depressed commodity prices during the pandemic-led recession, but the pace of increases is becoming concerning. Going forward, we'll be keeping an eye on the labor market, looking at the speed at which conditions tighten and wages grow, as this could suggest a more sustained rise in inflation, which could mean higher rates affecting both the stock and bond markets. And that's been your Market Minute for the month of June. Thanks for listening.